Some of the market participants were actually thinking that the Federal Reserve has inflation under control. The market became disappointed. And also, Jerome Powell came out afterwards. It even became worse.
I'm going to pass it on over to Kelly. And please tell us, explain to us what happened today.
In context, I think right now it's pretty clear that the market wants to go up. There is an underlying bid to the market. There is a prevailing idea, especially with the new kinds of money managers out there, which are literally maybe 10 or 15 years, not quite as old as I am, that have never really seen, except early on in their career, the 2008 financial crisis, but of course, very few of them have seen the 1980s inflation issues that occurred literally from 1978 all the way through 1982, and even beyond that. The last time there was this kind of an inflation, it was caused by wage price inflation. Wage price inflation is essentially when jobs became very hard to pay people. At that time, it was due to unions. And in the 80s, the unions kind of lost all of their power as a result of a sentiment at that time that prevented unions from increasing their wages easily by holding hostage one entity in a sector, like hold GM hostage, and therefore Ford and Chrysler will follow suit on whatever deal GM makes with the union. We are seeing something very similar to that now. Right now, early on, it was price inflation as a result of the money put into the system, and at that time, people coming back to work, a combination of both. Now, even though we've seen energy prices fall, we are now starting to see a labor market that has been squeezed. It's very tight. They're putting on a lot of jobs, as Jerome Powell said today, about 272,000 jobs, literally per month, which is a good number. We're still at low employment, even though we have a much higher, a lower participatory rate. So all that is a bunch of kind of economic talk that boils down to this. Interest rates are going to continue to go up, albeit they won't go up about 75 basis points per meeting. They will now maybe go up at 50 basis points per meeting. Today, the market became disappointed when came out with a 50 basis point rise. Some of the market participants were actually believing that there would only be a 25 basis point rise, or maybe even none, thinking that the Federal Reserve has inflation under control. We saw 50 basis points, not 25 or 0. And also, Jerome Powell came out afterwards, and when he talked afterwards, it even became worse. And what he said afterwards is they are going to remain diligent in the course of inflation, which means they will hike rates further in February, which will be their next meeting. So look for another 50 basis points in February. That's going to put us at 5.25 on the shorter term 2-year notes and the Fed funds rate. And also look for longer interest rates to start to kind of creep back up again to maintain around as much as a 2% or lower spread. Right now it's at 2% spread, and I expect it to go to 1%, which means I expect interest rates that have come down 1 full percentage point on the 10-year note to literally go back up another 50 basis points by February. So the market became at where I'll reiterate, the market was disappointed that the Fed raised rates at all. And then they didn't like his language afterwards, and they took away a 300-point rally on the Dow and turned it negative by the end of the day. And by the way, yesterday was another example of the market trying to understand where it wants to go up, But the reality is there's a lot of supply at a higher price. So this being said, the reason we're doing 2 times a month now on this AI circle is because in general, I think the markets deserve that. I think our customers deserve to hear really a little piece of at least what I think is my experience in seeing these kind of things before, and what our expectations are of both. So we have a general idea of where the expectations of the market is going to go. And by the way, what our algo, machine learning, AI will do in these kind of events and this kind of world that we now live in. So I still expect on a go-forward basis that the market will maintain a bid the best it can through Christmas, maybe even New Year's, maybe making the market go up another 100 S&P points, but it could be down another 100 S&P points very easily within the next remaining 2 weeks of the year. Finally, I expect in the beginning of next year, the markets to resume a downward trend. We are at the high point of our move on the S&P. Here is the S&P 500 spider. Kind of interesting, and I pointed this out, look at the end of the year of 2021, December, right here is the end of the year. There's the 31st of December, literally a high for the year at the end of 2021. Let's look at it at the end of March, the first quarter. From this first quarter, we made a low in March that literally took it from an upper standard deviation to a lower, literally about an 8% move, and then a rally at the end of March to kind of close out March. Not so bad. That was March means the first quarter. The second quarter, however, ended up absolutely terrible. We had a complete fallout of around literally about 11% at that time, putting the S&P down 24% of the year, followed by a little modest tiny rally to end the second quarter, literally very close to its lows. The third quarter had a very surprising rally in July. Look at that. It made a high all the way back up to 4,300 in the S&P, where people were at that time were thinking in the middle of August that maybe this isn't a bear market. Here is when people were saying the move is done, the lows are in, only to see what happened literally by the end of the third quarter, where it set a low. Literally, the last day of September, it made a low for the year. Notice how the market is putting in highs at the end of the quarters and lows generally towards the lows inside the quarters, and then lows literally on the dot, as we saw here for the third quarter, where it put in a low. The fourth quarter has been a good rally, but not like the rally that we saw in the third quarter, only to fail by the end of the third quarter. Here's what we have now. We've had literally an 8.5% rally in the S&P, putting the S&P year to date still down a lofty 17% on the year. And here sure looks like resistance. This here is close to a 200-day moving average. This sure looks like resistance to me. I would be a seller here in my old capacity, and I would be risking maybe these highs. I expect the market in the beginning of the first quarter of next year to resume and literally make new lows. At the time of the first quarter, however, I do see a possible entry point for the S&P 500, and that bodes well for a lot of other stocks. Literally by the end of the first quarter, should we reach levels around 35 to 3,400. I do not anticipate a rally above these levels, but look for our possibility that the AI, however, is turning more friendly, and we are starting to get minor signals to be able to push us into the market. And at the end of the day, whatever my opinion is, folks, we will follow the math. But so other people understand, and this is kind of important as well before we get into question taking. This is the S&P 500. This represents the benchmark that we all care about. This is the real world. What is not, but look at the NASDAQ here. Let's take a close look at that. The NASDAQ, everybody, is down quite a bit worse. The NASDAQ is literally down 5,000 points as of now, and it's off its lows. That it represents a 32% loss on the year. And the NASDAQ, of course, contains the stocks like Apple and Amazon, and we know them, Google, Meta, all of those kind of Netflix. We know these stocks. These stocks have been devastated. Most everything I follow has been devastated outside of the oil stocks. So these things don't show any kind of recovery, really. They're off their lows, but look in the first quarter for these stocks to possibly make some new lows, however, probably overperform the S&P. What has done well, and what unfortunately the world watches, is the Dow Jones. The Dow Jones, of course, is the most meaningless index there is. The Dow Jones is only literally down about 10% on the year, maybe 9%. But that doesn't represent reality. We are talking about 30 stocks. And when you see the pundits and the talking heads on television talking about the rally, they'll have a little sign saying market in rally mode and market rally, and yet the NASDAQ will be down on the day. The S&P may be flat on the day, but they'll signal market rally. Why? Because they only watch this index. And this index is poorly created, not representative of the country and truly what's going on. Before I leave and get into question mode, let's quickly look at the dollar. I think that's very important. The dollar continues to make new lows. It has definitely come off its highs recently, and we can see the dollar index at one time was as high as around 114. It's all the way down to 103. We know that's approximately an 11% loss. The euro has went from literally below par to 106. However, it's down massively through the year, but it's undergoing a rally. Why? Because traders in the US are expecting lower interest rates. Lower interest rates mean other currencies can compete more with the dollar, meaning that their stocks might look better, so they don't want to buy any more dollars to buy our stocks or bonds. Then they will go for their own currency bonds or their own currency stocks. And let's look at the yen, because I've talked about it. Mm-hmm. Yen has also finally come off of its highs. But again, when interest rates start to go up again next year, early in the year, look for this to resume a rally where the dollar will continue to rise up. However, we may have seen the highs here. And this play, I have done some work on, and we may offer an ETF product that will manage this situation. I want everybody to look for that as one of the things for early in the first quarter of next year. Mm-hmm. Finally, we should look at Bitcoin. Given all the stuff that has gone on recently, especially with FTX, Bitcoin is kind of hanging in there, folks. I think the worst is over for this, even though the contagion still exists. I do not recommend buying this. However, if you own it, I wouldn't sell it, and look to possibly be more interesting if we can start to see a rally of Bitcoin above 22,000 or so, in which case I could tell you our products will signal a buy. We've been out of this forever in terms of our algorithmic AI approach. The algorithmic AI approach is excellent on this particular kind of product, and we all use Global Bitcoin Trust. I think that's going to hang in there. It's doing the same, it's behaving pretty much the same way Bitcoin is, which is all we really care about. And so it still remains a good proxy. Finally, real quick, I'm sorry it's going over, Aaron, by 3 minutes. Let's look at the 10-year note. 10-year note, look at this. Today, we had, the market was pretty much flat on the day. I feel this is a long-term deep bear market, which I remember this could last literally cycles that could last for years to come. If this is true, that does not bode well for the stock market. We want to maintain higher cash positions, and we will look for more dividend plays that will come out in, for example, the conservative plus and a dividend product as well. We are working on all kinds of new strategic portfolios to represent opportunity we feel that can be managed again through computers and mathematics. So on that note, by the way, anybody that looks at this chart, if you can see it, that sure doesn't look like something I really want to buy. If you consider, if we can go back far enough, that this market came, this is as far back as we can go, but I can tell you, this market came from the price of 60. As far back as I go here is 107. It was literally almost half this price over here on the left side of the screen. And we are now looking back literally to 2006 before the financial crisis. We are in a new world with interest rates. And as a result of that, we cannot just get overly zealous in the stock market, despite the zeal that we all see periodically on the TV shows. And remember, those TV shows are designed to make people feel comfortable with owning stocks.
Right.
And so that is a misnomer. These are not traders. These are just talking heads that are promoting their own book. And I would, of course, like them to be correct. The market is easier to make money on when the market is going up. Very difficult when it's going down. But nonetheless, it's very reasonable to see interest rates rise. And the stock market, of course, will be the last one to understand what the problems are. It is forever optimistic. That's why it goes up. The bond market, however, I think remains the smarter money. And what happens in the bond market is what I really want to follow, because ultimately stocks must behave in accordance to interest rate parity. This is the one thing I learned in my career, and no mathematics will stop that.
There was a looming presumption that the Fed had inflation under control. Why might they assume that going into the Fed announcement? Can you clarify that a little bit?
It's because they can see what the bond market has done here, and I strategically did that one last. The bond market has started to rally as well in price, which means that yields go down. This is the 10-year note. The reduction of this gives especially stock participants a time to feel they have now hit a bottom, because the interest rate market seems to have bottomed. But if we look here back again in the middle of June, sorry, the end of June, it was the end of the third quarter, it did the same thing. It had a rally of greater magnitude than the one we have now, only to subsequently fail and make new lows. Again, over the beginning, since the end of COVID, this is where COVID is, right? March of 20, interest rates literally hit their lows. Mm-hmm. March of 20 is COVID, we now know. Ever since then, they've made no new highs. It just keeps trying. And what this is, interest rates are a function of all the money that's in the economy. And now they are realizing that money is being taken out. If it's taken out, that means they're raising rates and they're reducing their balance sheet by no longer doing bond repurchases. Interest rates have gone down, up in yield and down in price. I look at this as no more, is just a bull rally in a bear market.